Hey everybody, good morning and welcome to episode 11 of EPM Coffee Chat podcast. Very excited to be here talking about an interesting topic today. We have a guest. I will go ahead and introduce, I'll let Asmat introduce our guest, but yeah, let's get started on this episode.
Hi everyone, good morning. Thank you for being here. So today we are episode number 11, if I recall correctly. And we have our special guest today from Treasury Cube, Faisal Masood. He's based in Chicago. I think I know him for the last 6, 7 years now. Before COVID, we met, started talking about EPM and other areas of finance and FP&A. So happy to have you, Faisal, on our podcast. Maybe if you want to introduce yourself.
Yeah, no, thank you so much, Asmat. Love the opportunity. Thanks for the opportunity. It seems like ages ago that COVID hit. Now you just said 6, 7 years. It's actually
Yeah.
just very recent memory. It looks like it was just very happened very recently, and so many years passed by. The
Mm.
only one thing that probably we did enjoy was the working from home. And then after that, for whoever it went away, it went away. But that's the one good part of it. But everything else has passed by like a blur. When it comes to my introductions, yeah, I'm a co-founder with Treasury Cube, primarily responsible for the marketing and business development side, as well as the strategy side of things. Uh, Treasury Cube was built, we started building Treasury Cube back in June 2020. We started onboarding our first customers in June 2024, and we've presented in numerous forums after that, like AFP, like Windy City, with like Texpo. There are different treasury conferences that happen throughout the country. Uh, as a background, I'm a chartered accountant. I'm a CPA as well. I've worked in FP&A. I've worked as a controller, as a CFO, as a product person within financial services. So I have like a diversified experience set, and that allows me to understand the whole aspect of finance in the office of the CFO. And for the last 5, 6 years, besides treasury, I've worked with finance transformations and finance solution architecture, which isn't specific to EPMs or ERPs, but encompasses everything, including EPM, ERP, the BI reporting, and the systems around it and how that architecture is built out. So love to have this opportunity to talk about treasury and how we see the treasury landscape evolving.
Okay,
Sounds good.
awesome. Thank you, Faisal. Welcome. We are excited to be talking about the topics. I think this is going to be a very good learning opportunity for myself, and I'm pretty sure for a lot of EPM folks as well. Before we get started, I know you have a few slides that we want to share and talk about. Before we get started, can you maybe give an idea about the difference between a normal FP&A person and somebody who is managing treasury?
No, absolutely. Now, when it comes to FP&A is pretty much around your planning when it comes to your future predictions, but it involves accruals and cash, right? So an FP&A person will be involved in creating the future F planning or budgets or forecasts and updating them. And they will keep in mind the entire holistic profitability or EBITDA, however you're measuring your bottom line in mind. When it comes to a treasury function, you're looking at primarily someone looking at pure cash flows for the objective of managing liquidity, managing your short-term operational cash, having sufficient cash, and so on. So although they overlap, they are distinctly different, but they have different objectives. The objective is profitability, cost control, etc. on FP&A side, and it is cash management and liquidity, ensuring you have enough money to cover your expenses on the liquidity side. And there are two types of companies. One is we call them pre-treasury companies, and one is we call them post-treasury companies. Pre-treasury companies, you have someone in FP&A doing the cash forecast as well as the FP&A forecast, and the FP&A forecast is modified to build a cash forecast. While in
Yeah.
post-treasury companies, the complexity of the cash management requires a proper system. It has a separate department. So wherever you see a treasury manager, you need to understand within that company, the treasury function is a separate function and the complexity is much higher than what you would normally face. So that's how you could distinguish between, and those are usually larger companies. And we can get more into that when we go through the slides.
Great, thank you. Yeah, so maybe we get started with the slides and then we can educate everybody on TMS.
Sorry, just really quickly, I wanted to follow up, Faisal. Really curious. So you mentioned that treasury team, they usually have a little different objective with the cash management. I was curious, based on your experience, where do you see this, treasury team is formed, and then when organization is focused more on cash, is it, for example, is it more relevant to large organizations where they would like to efficiently organize and use their cash, whether it's investing in the short and long term, and that's why they need, I would guess, something like direct cash flow and versus indirect cash flow in FP&A, or is it also relevant for smaller and mid-sized companies where they might face with the lack of cash at some point of in the future?
That's a great question. So let me take you through basically let's go through this, take the basics out of things, right? So when we talked about pre-treasury and post-treasury companies, right, what's treasury and cash management is more of a support function, right? In medium to smaller organizations, it has a couple of individuals under the FP&A team. They might be part of the AP/AR team, but then there's not enough complexity. And when I say complexity, it means geographical complexity, debt, derivatives, needing multiple ERPs, having a private equity sponsor to report to. So there's complexity involved in the cash management and treasury management. And we'll get into that distinction in a bit in some of the other slides. But then the need for a treasury system evolves when to function, you need a separate treasury management system, as well as you need to manage the banking relationships, the complexity of things, so that the organization itself does not get into risk. So it's more of a forward-looking aspect of it. And I'll go to my first slide. Actually, the first slide is exactly as you just asked, like, what is treasury? A lot of finance folks keep wondering, what is treasury? But treasurers, wherever you see the treasury title, that will be a larger organization. Smaller organizations or medium-sized organizations do not have a treasurer. They have one person or two people in FP&A who are working through the cash forecast and the cash positioning, right? So let's talk about what a treasury management is not, and then we'll get to what treasury management is. Now, treasury management or cash management is not accounting. It's not a backward-looking process to create accounting entries. It's not a substitute for ingesting AP invoices, entering them in the ERP, paying them, or it's not a dunning system. It's not an AR assignment to when you get receipts into the bank, you're assigning it to the actual customer. It is not that, right? It's not an FP&A. It does not involve accruals, although you can accrue interest and so on, but at the same time, that's not what its primary function are. So each of these aspects of finance have a touch point with treasury, but they are not the primary tool for those functions. That resides within the ERP. And then when it comes to some other factors, it could be the EPM as well, but these reside within the ERP. What a treasury management system is what treasury management is. Let's talk about systems later. It's two things. One is the cash management, is the operational side of things, which every department has to do, which takes the cash visibility and the payments. But when you talk about the strategic aspects of things, it's looking ahead, and that includes like the things we talked about, liquidity management, investing. If you have surplus cash, where are you going to invest it? Money markets, overnight, cash sweeps. If you have foreign currency exposure, or you're dealing with iron as a commodity or copper or cattle, or you're looking at hedging your investment in a volatile currency country, then you look at hedging, right? And remember, hedging is also includes hedge effectiveness, which is an accounting requirement and an audit requirement, where you have to determine the effectiveness of the hedges and put that into other comprehensive income, which basically requires you to identify the effectiveness of the hedges, of what you hedged versus what your cost is being, right? So then the capital structure optimization, how much debt is good for the company, how much equity is needed, whether you'll need a recapitalization. The risk management just has a lot of reporting of what your positions are. And then there's always the banking relationship management on your lending, or your bank fees and so on. So the risk management is more of a strategic part, and then the cash management is a more operational part. So Fred, does that answer your question?
Yeah, I think
You
so.
look uncertain. Go ahead.
The only thing I was also curious if this would be relevant to small and maybe mid-size organizations where they have some seasonality. Maybe they can use their cash more efficiently. For example, they can purchase some of the goods before when the price is very low. So then when the price goes up, they will save some cash, or you can let shareholders know that they can use only a certain amount of cash as a dividend and not get all cash that they currently have in the organization. So maybe something like this. So I was looking if this is relevant to that or not.
So let's take it from a practical point of view. Within a medium-sized organization, let's say it's up to 300 million, or let's say that's pretty much what we look at as a medium-sized organization. I'll go to some statistics, and then I'll answer your question. The statistics are, this is an AFP survey from 2024, is that companies with up to 250 million revenue, which you can call medium-sized companies in the US at least, they don't have a TMS, right? What's their first priority? It's their ERP. And then it's their EPM or their reporting system if they have more than one ERP, right? So when it comes to their priorities, teams are not that big that you can actually have a separate person looking at working capital optimization, or planning ahead with where a lot of capital is stuck in working capital or inventory, so on, or in receivables, right? So they don't have that kind of bandwidth. That is where you can't say that, okay, let's put a TMS, but there are cash tools available where you can see your cash balances, and you can have a sort of machine learning generated predictive forecast. But that is where today's environment, the way the treasury space has evolved, is that for small and medium-sized companies, you can plug into your banks, and the whole API regulations have streamlined that, where you don't have to go through lengthy processes to connect to a bank. So you can see your cash balances in one place from 3 banks. But then most of the companies who don't have a cash management tool or a TMS will just download the bank statements, and they'll basically look at the balances in Excel or the ERP, do the reconciliation in the ERP, and they'll get through that. Having a separate system is always the second priority, primarily because your bread and butter is your ERP, without which you cannot function. And a cash management tool used to be luxury, but now things have changed, wherein cash tools and the pricing points at which cash tools are available is much more economical and available to small and mid-sized companies. So yes, today the treasury landscape has evolved in a way that you can get a cash management tool in a couple of grand a month, and that augments or basically reduces the effort required to manually go and pull things into Excel and then upload them into your ERP. So that is exactly where I think the value has come in, wherein those systems are not as expensive. The players in the past catered to large organizations with 1 billion plus revenue, actually 1 to 10 billion, almost all of them, because the complexity over there, you can't operate without a TMS, right? But then for the smaller players, the treasury landscape now provides tools where you can see your cash balances and make a limited amount of payments. So yes, you can use that, but only for a few things: making payments, getting your cash balances from different banks, and maybe having some fancy cash forecasting dashboards.
Got it. This is cool. Yeah, thanks so much. This is a great insight. And if I can quickly follow up, so when you say the numbers like 2K per month for small and mid-sized organizations, the average price for the tool like this, I don't know if you know, but what is the average ROI for for this tool once they implement it? Do they really save funds? Do they use them more efficiently?
So that depends on the scenario, right? You have two banks, 10 bank accounts, you make 50 payments or 100 payments a month. There's no particular ROI on that one, right?
I see, yeah.
Now imagine you have 5 banks, 50 bank accounts, and 500 payments a month. And the time to process those and check those payments from the ERP, then you start building out the ROI, right? When it comes to the payment process, when it comes to so it's not only complexity, it's also volumes. Then you also the AR receipts coming in that you don't recognize, sending them to the accounting system. So it all requires investigation and so on, right? So that's when the ROI comes in. You don't have to collect 50 bank accounts and get their position, and it takes you half a day to do that. You don't have to do that anymore. And that's where you start building those efficiencies, anywhere between, I think, 30 to 60%, depending on how complex the process is within a organization. And again, as the organization gets bigger and more complex, and let's say you have a group structure with multiple subsidiaries, then you're looking at, yes, then they will add ROI. But for smaller and medium-sized companies with just lower volumes, you can do it in Excel, you can do it for a cash tool. And that's where you need to know what you want and what you need. And that's where a lot of finance folks get confused. But finance, the CFO, the financial controller have become audiences for treasury management applications all over the world. And that's how the treasury landscape has evolved, because of the newer players who have come in and they're offering cash visibility part. And during COVID, to add something to this whole discussion, you couldn't go to the bank. Everyone needed to work remote. You couldn't go meet people. So then everything had to move online. And to be able to do that, that's where these systems blew up, right? And that is why you have a lot of players today who you can leverage to be able to get your cash position.
Got it. This makes so much more sense now to me. Thank you so much for clarification.
Faisal, I had a question on, if you go to the previous slide 2, I believe. So just to confirm, right? So you've mentioned like accounts payable and receivable. It still is an input into the treasury management system, although that is not our end goal of looking at that, but still an input into the treasury management system, yeah?
Absolutely. It's an absolute input into the treasury management system. And I can go to a slide where you can see exactly why it's and how the input works, right? So when it comes to a TMS, a truly enterprise-grade treasury management system will not will be able to integrate with any ERP. So you can pick up any ERP and send the payment files. What is a payment file? It's your beneficiary details, it's the amount, the transaction details sent to a ERP, which to the TMS, which ingests that data. If it needs to be enriched with, let's say, payment details, that this is the bank account, and if there's a intermediary bank in between, then these are the details, and then you're going to make them payments via ACH or SWIFT or wire those details, and then that's where in the treasury system you can approve that, or if it's coming via an approved workflow from the ERP, you can also say that let it go straight through, and then payments are released every day in a batch, depending on whether they're ACHs, wires, and so on, and the cutoff. But the whole idea is that a treasury management system touches AP, touches AR, touches the cash and the P&L side of things, and provides the accounting entries back to it. So you're sending a file to make a payment. Once that payment comes back in your bank statement, Then you say, yes, we reconciled it. A good treasury management system should have a bank reconciliation module. And once that's reconciled, the accounting is passed back as a cash offset, right? So you have an AP control or an AR control account. And then where every time you receive $1 million, let's say, you're putting that against your AR. And when you receive that, then the AR has to settle that through a clearing account with the actual accounts receivable customers who have paid. So then you're ensuring the control for every cycle or every receipt batch that you send to the ERP is correct, right? Similarly for the AP. And then there are other things that you can make, like counterparty treasury payments, bank fees, if you're paying for an LC or you're paying for, a connectivity fee and so on. Then those are direct payments via the treasury system. And then there are receipts that you get that you didn't know of. But then when you create this control process with your ERPs using control accounts, then the application of the AR is the ERP side or the AR department. And then pulling and identifying those cash receipts is the treasury. And this is something like a distinction between what AR would do and what a treasury system would do, or an AP would do and what a treasury system would do, how they interact. But absolutely, they touch on multiple levels. But again, a good treasury system will provide the cash accounting, and the AR AP will take that and allocate it to your, whether it's your vendors or your customers, it will allocate it there, or your expenses. So there's a distinction. We're talking about cash accounting or a subledger, and then on the ERP side is all the accounting.
Yep. Got it.
Now we'll get back to the slide to talk about more things that the CRMS does, but we can head back to what problem does a TMS solve, right? We can talk through that. Now, a separate treasury management system looks at certain things, right? Cash management, we talked about making payments, looking at what your cash balances are. Then you look at, when it comes to the TMS, what you're looking at is that you're managing your liquidity pool. You have 10 bank accounts, and then you have 5 entities, and then 3 ERPs. You need to consolidate and report out on those things. Let's say you have a property management company and you have cash flows coming in for each property, and then in the cash flow, you're looking at, okay, these are the expenses I'm spending for capital improvements, and these are the rents, and these are the expenses for just the utilities and the garbage removal and so on. So all of that put together, you have to categorize each transaction coming into the bank, and then send it back to the ERP. But what you're doing is you're also identifying the actual cash receipts and payments from the bank statement in a cash forecast, right? And now today, when you have a lot of debt, I mean, there's a lot of companies that are private equity owned these days, and managing that debt versus your inflows is very critical, especially if you're highly levered, right? Then the efficiencies related to making payments and then investing your cash. If you have idle cash and you have, let's say, 3 subsidiaries that are cash poor, and then, or retail, one is retail and 3 are cash poor and have a lot of money tied in working capital, you can create an in-house bank wherein the cash-rich subsidiary provides money to the cash-poor subsidiaries, and the accounting is done within the treasury system and passed back to the individual ERP. How that matters, it reduces your borrowing costs, right? So there are different structures we can use within in-house a treasury system, not a cash management tool. They don't have that capability. It's a treasury system that you need to be able to manage, let's say, your cash and liquidity with higher interest rates these days. The automation part is obviously the efficiency aspect of things, forecasting cash needs, that's the looking forward aspect of things. And then within that, you have the short-term cash forecast, 13-week is the standard for a treasurer. And then you have today's position saying that, okay, I have this much money in these accounts, and then I'll fall short in this account. I need to transfer money between these accounts before the payment run can go through. Right, so there's that aspect of things, and then obviously you have other things like the reconciliation and the operational back office aspect of things, where you're reconciling bank transactions with payments made from the treasury system. Remember, if you get bank transactions, it's not necessary that a team is making their payments from a treasury system. They can make it up from the ERP directly if that's what the path they want to go to. But then when it comes to the forecast, you always have to be able to bring in the transactions from the bank and categorize them. And that is the input to your future cash forecast. It's also the input to do actuals versus cash forecasting, because you're categorizing each of your bank transaction into the categories that you use for OPEX or CAPEX, however that goes through, and revenue, of course.
I have a question, Faisal. Do you see there is I know you're talking about the connection with bank system and TMS and ERP, but do you see there is a demand for crypto transactions? Any crypto-related
Absolutely
transactions?
not.
No?
That's more of a shenanigan. I mean, a crypto or a crypto ETF is an investment, right?
Yeah.
You cannot buy goods and services without paying hefty exchange fees. Even if you do, it's more like a cash transaction with we don't know how much of fees are charged by Coinbase or those ATMs and so on. And there are a lot of people who are peddling it, but I can assure you within corporates, within enterprises, with proper policies, if no one is investing or using crypto as a medium of exchange. It's some companies like Tesla and so on, or Block, um, previously Square, they would use that as an investment, right? Or they're trying to create an ecosystem for payments. But in the end of the day, it's an investment which has to be marked to market. It is not a medium of exchange for making a payment. If a payment value, think about if you owe someone $100 and then you pay them $100 in crypto, and then suddenly the value of it drops to 90, who's responsible in that same day? Who's responsible for the difference? So there are many operational challenges when it comes to crypto and using it as a medium of exchange. It's an investment, just like a bond is or a stock is.
I see. Because in my mind, it was like, let's say we live in Canada. For us, local currency is Canadian currency. And then if someone pays us, for example, for something in USD, then that value can also go up and down, very similar, like you said, in crypto. So I was thinking, like in case with Tesla, for example, if someone pays in crypto, isn't it similar to like currency fluctuates?
No, it's not. Currencies don't fluctuate the way crypto fluctuates. In the end of the day, is there universal acceptability of crypto as a medium of exchange? Many people are trying, many people are pushing it. US current administration policies support it, but in the end of the day, it's not a medium of exchange universally acceptable.
Got it.
So no proper treasury system will look at it as a medium of exchange. And remember, banking communication has a few standards, right? Banks talk to each other, corporate systems talk to banks. There's a SWIFT standard, there's a BAI. So SWIFT standard is BAI, but there's a CAMT, there's BAI files. These are a few standards that are used. In Europe, you have a SEPA, which is like our ACH, local ACH. Yeah, sorry, in the US, it's ACH. But then there are separate standards for banking communication. There are protocols. Each message has a secure encryption, decryption, and there's a format that you send to the bank, which identifies who the beneficiary is and so on and so forth. And that banking communication, there is no messaging format for even crypto today, right? So there's a whole infrastructure that needs to be built for being able to execute transactions. Banks can talk to each other, corporates can talk to the banks via the SWIFT network and other networks. But in the end of the day, there's no infrastructure in place for that same language that whether a bank in Africa or China talks to each other. And that's primarily the standards that I talk about. So until those come in place, crypto will never be a medium of exchange.
I see. So it's not in a foreseeable future.
Not the way it's running right now.
I see. Got it. Thank you.
I think that's a very good point, Fred and Faisal. Like, so how does a TMS or a treasury, like how does the architecture? I know you had a slide. I think I was just going through the slides. So do you want to maybe just go at a high level of how the architecture works with the ERP, EPM systems that we have seen?
Yeah, so the EPM systems, when you talk about Oracle does have a Oracle Cloud predictive cash forecasting in the EPM, as well as Oracle Fusion Cash Management It's more like a mid-sized to large-sized company treasury module for Oracle ERPs, mainly Oracle Fusion. Oracle NetSuite has a smaller version. It's called Cash 360, which has some embedded payment formats that you can transmit to the bank, creates a file, and then you can connect that to the bank. But the whole idea is that within the ERP, you're having everything is in the same place, right? Your payments, and then you're basically approving the payment, sending it to the bank, and then you can get back the bank transactions and the balances, which you create your cash position for. You do your bank reconciliation. It's all native to the Oracle ERP, Oracle Fusion, and then at the same time, you basically can just do the reconciliations as well, right? So it's a self-contained ecosystem within the ERP. But when it comes to multiple ERPs, when it comes to group structures, that's when you have to evolve and move into a different landscape. And that landscape is you're agnostic to the ERP. The ERP just generates files and then sends it to the treasury system. The treasury system based on actual transactions. So there's a concept of, let's say, payment and settlement, right? Mm-hmm. So or you can call it a trade. Even making a payment can be called a trade. The trade and settlement. So the trade, you sent the instruction to the bank. If it's a wire, you'll get an acknowledgement because there's a Fed wire acknowledgement for the US dollar transfers, right? But some of the other payments, you'll get an acknowledgement that the bank received the file, but whether it was processed or not is a different matter, right? Beneficiary details can be incorrect and so on. So those are operational matters. But then the settlement is primarily when it's been settled in your bank statement, right? So within the bank statement, when you receive it back, you always have an available balance and a ledger balance. So the available balance is net of the float, and the float is what transactions haven't settled yet, but they have either come in, the money's come in, or payment has been presented, but it hasn't gone out yet. So that's the float. Then you have the available and the closing balance. When you look at what a TMS does, right, and we're not talking about cash tools, which just bring you your cash balances. What they do is they pull that data from the ERP, make the payments with a cash management scenario. It can be straight through. You can run through multiple approval levels. You can even we had a client where, they would have had 1,000 payments a day for distribution of checks to individuals who are going through a installment plan for consolidating their debt and so on, right? So that was their disbursement. But then system sent the file. It was not approved. It just went through and then it's released before the cutoff time every single day. So you don't need an approval level because the system generated one. And the system managing those installment plans or disbursements for hardship loans basically would send the file through. Otherwise, if there are other types of things that the treasurer, if there are 500 payments a month or 1,000, what benefit would it be for a CFO to look at each of them and try to figure out whether this is legitimate or not? So the approval workflows change depending on the organization and what payments you want to look at, value-wise, and so on. At the same time, you also have beneficiary data, which is called master data within the treasury system, where you need to make sure that someone doesn't go in and change the beneficiary of the payment, right? I put my name instead of another company's name with the same bank account details in certain messaging formats like ACH. Doesn't matter what the name is. It's just the bank account because the message format is so small that, that money can be transferred even if Arun, for example's name is there, but it's my bank account. So there are safeguards that need to be put in place when it comes to the approval workflows. Some checks are a little bit more secure because there's a regulatory burden on the bank if it's incorrectly presented. But when it comes to wires or even real-time payments, which are done through APIs, once they're gone, they're gone. So, and they might not necessarily need to match any specific criteria. So there are different parameters, and that's where treasury system expertise comes in on the messaging formats used with the bank and so on. But the whole idea is that you're getting transactions from the bank, and then you're looking at, your bank balances and bank transaction. That's position is created from the bank balances. The transactions create the categorization of the transactions coming in, and then they account for it. So the posting rules can be applied for a Oracle system versus an SAP system versus a Sage to send the accounting back based on different chart of accounts, right? So the contra entry of the cash side is what is sent back to the ERP, right? We received this cash. We know this much was supposed to be received, but we received extra. We also create the accounting for that. In the ERP, they decide, okay, this came from this customer, and then we're going to post it to them. And then the account control balance, the AR control, for example, needs to be 0 at the end of every month, right? Otherwise, you have unreconciled receipts in there. At the same time, treasury system, when integrated, is not necessarily the best place for your debt or for your else letters of credit or letters of guarantees, the off-balance sheet, or if you have derivatives. The accounting can be pretty complex for derivatives, right? You have a fixed leg and then a variable leg as well. So in that, you have to value the hedge. So there are different aspects of it when it comes to what we are doing in a treasury. Now, the more complex the structure is, for example, if you have an in-house bank with a cash-rich company and a cash-poor company, and you're transferring all the time, there's this concept called POBO and ROBO, which is payment on behalf of, a receipt on behalf of. Imagine the accounting nightmare an accountant would have to go through. You need two resources, one on the sending side, one on the receiving side, to just do the accounting. So a treasury system can manage that if it has the facility of in-house banking, where it identifies those receipts or payments on behalf of. I'm using Arun's bank account to make a payment for my expenses, and then the accounting entry will be different when I'm using my bank account for my expenses, right? Or I'm receiving money for Azmat's business while, in my bank account, instead of receiving it from my own business in my bank account. So there's accounting that's generated for those in-house banks, and there are different arrangements. So there's a lot of, when it comes to the added complexity, that's where you realize that the ERP will not cut it, and you need to move to a proper treasury system, right? So those are the aspects that are involved in a general architecture for a integration with the treasury management system.
Yeah, I think this is a great insight on this, because I've seen a lot of clients that we work with Oracle, SAP, and some of the treasury system that they're using, especially on the ARCs, the account reconciliation module, where we have on the Oracle footprint, they do a lot of movement of transactions and reconciliation. So this really helps the visual.
Yeah, no, absolutely. So within a treasury management system, you have the bank transactions, settled transactions, and let's say you made payments. But there are a lot of transactions that are in the bank, but they're not in your ERP. So you have to create them as well, right? So first you have to match them with payments made. And let's say you had receivables. Then after that, you have to identify the unmatched ones, and then those need to be reconciled in the ERP. But then that makes sure that the cash is completely reconciled.
That's good.
Right.
Yep.
Hey, just another question is a little more high level. Let's say I'm a growing mid-sized corporation, and I'm currently doing my activities all in Excel spreadsheets. How would I know, what are some indicators to know when I've started to outgrow my spreadsheets and I would need a treasury management system?
So let's separate that. You're an FP&A planning that you're doing. Even very large organizations today still do it in Excel, because cash forecasting is it's a science as well as an art, right? So that space is evolving pretty rapidly with a lot of claims from different vendors, but let's break it down to basics, right? When it comes to the number of banks you have, number of bank accounts, the payment volume per month, and then after that, it comes to how many ERPs do you have? If it's still one ERP, that's fine. If it takes you, let's say, 1 hour to do all of this in the day, then probably it's not worth it. But now when it takes you more than an hour or several hours to be able to just bring in your cash position and identify, do I have money in these bank accounts to make these payments? Then your workload becomes such that you need to get into it. That's the operational aspect of things, right? When it comes to the cash forecasting aspect of things, a lot of companies need to know what their cash needs will be in the future, right? And that's where you can do it by account. And remember, a check bounces in an account, insufficient funds in an account, not in a by a legal entity and so on. So you need to manage that part. That's when you realize you will need a treasury management system. A lot of companies, small companies, mid-size, would still want to see what their cash position looks like. The owners would like to see that, and the visibility needs to be there. But the operational aspect is where these processes take a lot more time. And remember, within the US, if you're looking at, or Canada for that matter, when you're looking at, let's say 70 to $80 an hour for a resource, let's say you pay a accountant $80 to $150,000, depending on their seniority, right? And then that cost starts adding up because they're doing more of those functions. It's trying to bring time to bring in efficiency. Maybe in other countries where the cost of labor is less, then it's later. But then if you're a group structure and so on, then that doesn't matter because you need to do things real time, quickly. At the same time, cash deterioration, like the way it happened in COVID, that was one big reason why these systems gained a lot of popularity, was things were changing so fast. They needed to model out what happens if our vendors stop paying us, we furlough some staff, a complete scenario modeling of how your cash forecast would look if, and how you would survive if X or Y happened or you took X or Y action. So that is a big aspect of why the real-time visibility into cash, and then building out a forecast and doing a scenario model similar to a bank stress test, right? Where banks do a baseline, adverse, and severely adverse. CCAR testing was part of that, but then basically that was where they built out, if some things go wrong or go very wrong, what happens, right, over the next X period. So that is a scenario modeling that good cash forecasting tools provide too.
Yeah.
So that's actually, yeah, sorry, just to add, and that's also adds to just the audience we're looking at, right? Like you just said, when you look at treasurer and treasury teams versus the CFO, they want to know, reporting on an account-based structure, daily, weekly liquidity management, right? They want to help ensure that they're funded correctly, right? And if you have counterparties, which basically is a function of derivatives, but then you also need to know about that, but that doesn't apply to smaller companies. So the treasurer or treasury team looks at these things, and you're usually very lean teams. Even for a large organization, you have 1 to 5 resources, and they look at treasury in a dedicated manner. But the finance department can be much bigger. They're interested in what's our forecast when it comes to the next 3 months. Do we have enough cash, right? And they're interested in fraud. They're interested in operational risk. They're interested in what's our medium to long-term cash forecast. And then if we, let's say our revenue goes down by 20%, what is this going to look like, and so on. So they look at all of that. And that's where also there's a different story that can be told versus for an FP&A forecast, we think this should happen, versus a cash forecast where that is checked every single time, every single week, every single month. Usually you do it on a monthly basis, but every single month you get a reality check to this cash was promised, it is not in here, or this liquidation of inventory or pulling in receivables was guaranteed, it's not there. Or let's say on our debt side, our coverage was supposed to be this much. So there's a much more concrete reality check when it comes to cash versus planning. I mean, forecasts are moved around all the time, but when it comes to cash, it hits you much sooner. So there's a different audience that we're looking at when it comes to both of them, both of the issues that a cash treasury management system can solve.
So my
Sorry, go ahead,
question,
Arun.
Faisal. Yeah, my question was just thinking about some of the, let's say the organization's strategic plan, for example, mergers and acquisitions or expanding to new markets and things like that. Would that be an input into the treasury management system?
Absolutely. So we had a client who are subsidiaries of private equity. The fact that, number one, you can see the cash being generated in an organization, and we can go to a different slide which talks about this, wherein you can have the EBITDAs and so on, but then accounting measures in the end of the day, what Warren Buffett says about EBITDA, right? It has some French words in it, so I'm not going to repeat them, but basically, he doesn't even look at EBITDA. He looks at primarily accounting profits, or he looks at cash generation. But the whole idea is that with companies today within the private equity space, they do want to know what's your cash generation ability more than what they want to know about your EBITDA, right? Because the sales metrics are usually around X multiple multiplied by EBITDA. But in the end of the day, when you're looking at the cash generation ability, that's the proof in the pudding, right? So when it comes to long range, either a forecast or whether it's actuals, the history and the cash generation ability adds to the multiples that you can gain. So the saying in private equity industry is, if you have a proper EPM consolidating tool, you have a proper ERP, and then you have a treasury system for cash visibility, everything 1+1 ends up being 2. So then you're not guessing that, this. So it adds at least one multiple to the price that you can attract from a potential buyer for a group of companies if you have the right systems in place. And that's what private equity companies called add value, or basically creating value in a company. Besides the sales and strategic aspects, creating value is also optimizing the operational structure. So when you're merging or you're basically separating out a company or doing a carve out, these factors create the reporting structure, which is called credible. And then they basically attract more buyers, where the equation makes sense. It's not only accounting, cash supports that. And then your systems are in place where it's not a lot of Excel manipulation.
Yeah. All right. You can continue with your flow, Faisal.
Okay, sounds good. So we talked a lot about, I probably just want to touch about, some of the main types of tools available. And there's this pretty good website called realtreasury.com. It just has, a portal where you can see who the cash players are, who the treasury and risk management players are. We are considered as a treasury and risk management player. We work in the enterprise space. Though we're one of the newer players, but then in the end of the day, it just separates it out. So you don't have to have that decision fatigue of what exactly you need. If this is what you need. You just need cash visibility and payments. Then you can look at the cash visibility and payment space. If you need the treasury and risk space, then you look at that space, right, where you have more complex structures, and you just don't look into the cash management tool players. So that's one particular aspect of things. And then one other thing I wanted to talk about was that, how do you get into a treasury career, right? A lot of folks are like finance people, and like they would want to know. And for that, I would definitely recommend the lady on LinkedIn. Her name is Jessica Oku. She basically publishes a lot of useful content. And then basically you can get cheat sheets and so on how to build a treasury career, what knowledge you need to gain. But then when it comes to treasury, it's a subset of finance, right? And within finance, what you're looking at is that you need to learn cash flow management. You need to learn about the risk management side, debt and the ratios and so on. You need to understand finance. It's all the basic skills, right? Treasury systems is just the add-on, which means, okay, they've worked on this system, so they'll be able to help us. And a treasurer will usually be from a bigger company, right? Wherever they've had a title of treasurer, they'll usually be from a bigger company, more of a leaner team. But obviously, there are teams like GE, which have thousands of people in their treasury. We can't go there. But point is that, you would generally have much smaller teams compared to finance. Then you need to understand compliance and regulations and then FP&A. And the main certifications around that are the same. I mean, there's an additional certification for certified treasury professionals. It's created by the AFP. AFP is basically a forum for finance, EPM, and ERP professionals. Actually, not as much as ERP, but EPM and finance professionals. And they provide the certification for CTP, this financial risk management. And then you have your typical accounting degrees. Or if you have a bachelor and you have studied accounting and finance, remember, treasury, you need finance. Accounting will not cut it. I'll tell you right now. or you'll have to learn it later on. Finance, which means the time value of money as a basic concept. Present value of discounted future cash flows is a fundamental understanding that you need to have to be able to manage liquidity. If I invest today, will my return be greater than just putting the money into a money market fund? There are a lot of decisions that need to be taken by a treasurer. So these are the designations you'll help. And I put in a link where there's a guide to how to get into the treasury professional, but then it's more like you get into finance and then you start learning these things in practice and you get the theoretical background on how you need to manage that. I wouldn't recommend the CFA because it's more like more for equity analysis and very deep analysis. They're much more complex analysis. And if you get there, then the CFA is primarily for more of your portfolio management and so on. The easier routes are, one of these certifications as well as a finance undergrad or one of these CPA or CAs or ACCAs. So this is the primary way. Get more details from here, or you can follow her on LinkedIn. But courtesy of her, I kind of put this in with her permission, and you can take a look at that. And she has a couple of cheat sheets as well, which will identify, just the basics or interview questions and so on. So that's helpful for anyone looking for a treasury-related job.
On this one, Faisal, if I can clarify your path to this treasury. So I know we discussed this before. Your background is in FP&A as well. Can you share a little bit story why you decided to go in this direction? What was your envision? How did you get in this field?
I didn't want to work for anyone. There was no reason. I don't want to work for a boss.
Oh, right. No. Sorry. I meant from FP&A to treasury.
No, absolutely. So I had the finance background. I had the product background. I worked as a cash product owner for trustee customer, basically wealth management clients, right? Asset managers who manage your 401ks and so on, and other investment funds. I worked on the banking side of things within the treasury space for a long time. Then obviously on the finance side, as a controller, you have to manage the finance and the payments and so on, but that's more operational. But the intersection of technology and finance was where I found it to be easy for me and the skill set. So I have done ERP implementations, I've done EPM implementations, I've done treasury implementations. Then it gives you a lot broader network on that. And then I met my partners who were some of the top consultants in the country for some of the larger players within the treasury space who've been around for 20 plus years. And they basically also had the vision that they wanted to democratize treasury. So then we all got together. I look at the finance and what the CFO likes looking at, and then he looks at what the treasurer likes looking at, and so on. So basically, this was the combination, and we built out a treasury management system, which models a lot of the risk side of things, as well as the cash management side of things. So the whole idea is that when there's no set path to this. You don't have to be a treasurer to build it, to get into treasury implementation space and so on. But what you do need is you need to have hands-on experience and understand the underlying concepts. And that's where I said accounting, undergraduate, finance, undergraduate, and then you must practice it. And modeling, Excel modeling is a great start. And then you move on from there.
Got it. Cool. That sounds great. Thank you.
Faisal, let's handle the elephant in the room, AI.
Oh yeah.
Let's talk about AI in treasury management.
Well, I must put a disclaimer. I don't have any nice things to say about it, but then let me just add some proof to it, right? So I did a speaking engagement in a summit conference called Windy City Summit. And I tried to put together an image, and this pretty much sums up what's happening. Fear is being monetized at scale. The large consulting firms, and we don't need to name them, have had 100%, 105.9% is the exact growth that they've had per year in the last 4 years since the AI revolution, sort of, right? They've gotten into companies, they've actually, done POCs and so on. But the whole idea is that AI is very useful for a consumer, people like us who want to generate content. It's had some pretty interesting use cases when it comes to sales and marketing, trying to, find the right person. Sometimes when you're talking to to someone on LinkedIn, you don't even know whether they're real or not. And then scam calls is another. I'm sure a lot of us are getting a lot of realistic sounding scam calls. So there's the different aspects to AI. But the whole idea is the boards have been pushing managements to adopt AI in one way or the other. And then everyone's looking at tools with AI, and therefore everyone is presenting themselves as AI first. But let's take to the core concepts, right? The principles right now. And I'm sorry if there are some NVIDIA or whatever investors here, but let's go to a report which was published last week. Actually, not last week, this week. The report talks about, this is done by MIT, by a bunch of independent researchers. And what they said is that when a lot of pilots have been run in terms of, on a limited scale, the pilots have been pretty successful, but then when you roll it out to the entire organization, there are too many things that go wrong. When it comes to coding, yeah, it helps. You can increase your efficiency by 15 to 20%. When it comes to actually generating revenue from it, it'll help you optimize some of the algorithms of who to target. But in the end of the day, it's like a co-working tool. It itself has not generated revenue or been able to create revenue sources, right? So the whole idea is that it's added to efficiencies. In the use cases that we're looking at, there's not been, most of the 80% of the projects have not gone to production in there. There's been exploratory, there's been about 40 billion investment from enterprises within the Gen AI space, but it hasn't generated the use cases which will generate the returns, right? So it's a helper, but it's not a leader. Let's put it this way, and it cannot be widespread deployed on a widespread basis, right? Having said that, there are different use cases that you can work through within AI, right? And within Treasury, the use cases. So this was a generic overview of the way we see it and the way we see vendors pushing AI capabilities. And to be honest, they have no choice. If you have everyone in a boardroom pushing the CFO and his teams to adopt AI, then everyone has to say that they do AI to be able to do it. But what are they actually doing, right? We'll talk about that in a bit. When it comes to AI, there are two main things that are happening today, right? You have the wrappers of ChatGPT or another AI model, which are looking at data. Just remember, please make sure that anyone who has the company's data is keeping it private. It's not being used to train the model. The data is presented, and then it does an analysis. Your sales dropped in this region, this customer. And remember, coming back to EPM implementations, right? The more metadata you have, the better your analysis will be. The more detailed planning you have, the better you can report actuals against that planning, right? It just depends on how well thought out. So there's no replacement for a good EPM implementation. There is no substitute for a good ERP implementation. The data has to be there. Accenture right now, most of the work it's doing, it has, I think, 20,000 people just combing the data and putting it in data lakes so that it can be read in an efficient way, right? The process would not be necessary if the data structures or the cubes for metadata around a number of the sales of this region, of this product in this time period, and then this division and so on, that metadata was available. So that is where the more metadata you have, the more AI can analyze and then put it in there. And then there's the machine learning, which is predictive analytics in a lot of platforms. Remember, the historical data, you provide historical data, it will learn the patterns and learn seasonality. There are a couple of pretty standard statistical algorithms. You have TensorFlow, which is a gift from Google, where the whole AI thing started. And that where it learns machine learning, and that's where it learns the patterns, and then you get the future prediction. That's predictive analytics, whether it's an EPM or whether it's in a treasury system. That's what they're leveraging, right? Now, I must caution that this does not apply to equity analysis, so on, because when, for example, you have a stock report its results and it drops by 5 or 15%, how do the algos decide within seconds how it's done, right? Those are real AI algorithms which are very quickly going to plug in the numbers and immediately execute a sell or a buy order for a certain percentage based on the valuation they come out in with, future present value, future cash flows, and so on, and growth and so on. So those guys really spend hundreds of millions of dollars on individual bespoke AI algorithms. And that's why within seconds after earning, you can get those pops or drops in stocks, right? So that's a different thing. So any questions around this?
No, I think, one of the discussions we had last time we met, Faisal, was there are generic AI models, obviously, and then there are, I guess, customized to your specific business needs or domains, right? So if you could talk a little bit about that, that would be great.
Yeah, so we do things a little bit differently, and it's going to take us a lot longer to do this. But the way we look at cash forecasting, for example, is that we go back to something called first principles thinking. Does anyone here know what first principles thinking is?
I don't.
Oh, maybe explain it.
Yeah, you can Google it, but first came from the Greek philosophy. It's a philosophical concept coming from Aristotle, and basically might not be Aristotle, but one of the philosophers in the Greek times, maybe Alexander, but wherein they talk about, and what it means basically is that you need to strip out all your current beliefs and assumptions of what you believe today, right? And remember, the core composition of a forecast is revenue and receivables, and then costs primarily. There are a lot of things that are pretty predictable: your payroll, your rents, your utilities, and so on. We're not talking about those things. Predictive modeling works fine for them. But then now you're just already going into differentiation between recurring cash flows with not a lot of variance versus very highly varying cash flows depending on which industry you're in and so on. If you're on a subscription model for softwares and you have all the data from a different system, yeah, you can pull it in. And remember, in the forecast, the first month or two, you can pull data from AR and AP based on the invoice payable or receivable dates. You can populate that. Beyond that, for medium and long range forecasts, you need to predict something, right? And you can learn from the past, but you need to predict the future. Now, to be able to do that, what we're looking at is that you need to strip out all the assumptions you have and then rebuild them based on what you know is true, right? And that's the causation aspect of things where you say, okay, this is true. And then you reconstruct your understanding. If you're in an infrastructure business versus a medical devices business versus a marijuana business, how does this impact my cash flows, right? Do you think your GDP growth, your inflation numbers, your employment growth, all of it affect different industries the same way? Why don't you answer that question? Do you think economic factors on a macro level affect your industries the same way?
No, yeah, I mean every industry has its own different economic factors, so things are different, right, based on your business. So yeah.
Exactly. So you're absolutely hit it on the spot. So like, let's say you had sales of X in the month of June last year, and at that time your GDP or the policies for the government on, let's say if you're a healthcare company, were this for reimbursement, you have this much of an average cycle and so on. And you can track that stuff for these data providers like Refinitiv, Bloomberg, and so on. That becomes the correlation that you say, whenever the cycle goes to 15 days, my receipts go down by a correlation of 1.321, right? And then if you can quantify that, you can quantify how your cash flows went up or down based on that correlation or that identifier. So it's a mix of industry-specific factors as well as macro factors that affects your business, and every industry has a separate thing. So at this point, we have that infrastructure in place. What we're doing is we're still gathering data. It's a big intensive process which works by industry. To just give you an example, if you look at a pharmaceutical industry and you're looking at what is the size, I mean, I can tell you based on historical data that economic cycles do not impact education or healthcare the way they would affect, if you're selling solar panels for your roof or you're selling new electrical equipment or new cars and so on, that does not affect the pharmaceutical. So then the correlation is much lower, right? The causation is different. But the causation is policies, insurance cycles, procurement cycles, Medicare reimbursement policies, and how you interact with them. That is where you'd look at a pharmaceutical industry, for example. Medical devices would be a little bit different, whether they're covered or they're not covered, and so on, right? If they're not covered, then there would be discretionary income. That would depend on unemployment and so on. So there are lots of factors that depend. What we see as the future is that you will have bespoke models by industry. You'll have something to do diagnose medical illness, some bespoke algorithms to identify mental health issues. Then you'll have others to work through, data related to X industry or Y industry, and the systems themselves will, instead of doing it all themselves, would basically have APIs where they can push data to those systems which have bespoke models catered to that specific industry or sector, and those would spit out, the forecast, for example, the predictive model. And that's where we see the future is, because no one company can do all of it, right? There are very few that can, maybe the ones who have moat, but then in the end of the day, this is where things are going, where you provide and then you connect to different models based on how they're built and catered to, and they're not generic ChatGPT or Claude or other wrappers, right? Because they're trained on everything. And all the AI companies that are growing or being created today, many of them will not be around, but the ones who will be ones who actually can take use cases like this. For example, in Treasury, the main use cases are AI bank transaction tagging, right? To be able to identify bank, because the lines that come from the bank transaction are so much gibberish that you look at them, you'll go crazy. It's all gibberish, identifying what transaction it is, what category it is, then cash forecasting, medium and long range. For 2 months out, 1.5 months out, you have the data in the ERP. That's what you'll pull. Then further out than that to model it, right? And then for that when the actuals come in, to learn from it and then basically predict the further future, right? So this where medium and long-term forecasts come out. So all in all, to cut the long story short, bespoke models, or basically one size doesn't fit all. You will need to have more specific data, specific algorithms which help you build cash flows. Because everyone predicting cash flow modeling, no one knows the future. They know the past, right? It can help you do operational tasks, but will it be able to predict the future? It will not. It will give you scenarios. And that is the most important thing to keep in mind when you're looking at someone's claims. Try to understand the model, how it's constructed, what's it's doing, machine learning, or it's actually applying some AI to it. And then make sure your data isn't exposed to a public domain. At the last least, you need to make sure that it's learning from the actual prediction versus forecast versus actual, and then incorporating that going forward. So there are many things that lenders will claim, but this is the real check. You need to be able to explain it, and you need to be able to look at these factors.
Yeah, got it. Okay.
So I'll
Anyone
conclude
else?
this whole thing. Yeah,
Yeah.
sorry. Before we
I was going to
conclude,
ask, like,
any other
anyone else
questions?
has any questions. After you conclude, I have one more question for you.
Sure. So the whole idea around treasury managers, you just need to know what you want. If you don't know what you want, find someone, a consultant who can tell you what you need, right? It's either you know what you want, and to be honest, a lot of CFOs say they know what they want, but then they might be pretending or they might not want. There's a certain degree of humility that you need to, if it's not your area of expertise, consult someone, right? There are many people around. Just know what you want. If you don't know what you want, then you need help, get someone's help to know what you need before you get in vendors and so on. So you don't have to spend a round of, 7 demos, and it can be exhausting, by the way. These demos can last for an hour and a half. It can be exhausting. You have to go to 5 demos within 3 weeks and then try to take a decision, and someone looks fancy, someone doesn't, and then someone works for your workflows, someone doesn't. There's so many pluses and minuses. You just need to know what you want, right? And then know what price point you can get. There are certain vendors who work with very high-end, very complex clients, and their implementation basics wouldn't even touch under $500,000, right? And there are certain vendors you can get implemented in $50,000 or less. So it just depends. You need to know what you can afford as well, and then look at your thing. But some of the factors around that are what I presented in the slide, and just take a look at them. But then you didn't need to identify volumes and complexity. These are the two main things you need to look at it for. And when you see that, then you'll be able to decide that, yes, I don't need a complex tool wherein I have to do derivatives and debt and so on, right? Or if I just have one loan and that's all I need to manage, you don't need a separate tool for that.
Yeah.
So volume, complexity, just keep those in mind. And these 3 points: know what you want, know what you need, and know what you can afford.
Thank you, Faisal. I have one question. What would be the top 3 features you would love to see in a TMS, treasury management system?
In a TMS, the basics are cash management payments, right? Those are cash visibility and payments. That no TMS should be without that, right? At the same time, when you look at, you must have a minimum of debt, your accounting entries, and then you must have very configurable reporting, because vendors can come in and then you have to be able to use it easily, right? Vendors can come in and they can have, you want to build a report of your cash balances by legal entity, and then you have, let's say, your property managed by property, and then let's say in each property, multiple owners own that property, right? And then you need to be able to configure reports in a much easier way. It must be user friendly, and that was one of the cores that we looked at when it came to building Treasury Cube. Is shouldn't have to go to the back end to build it. Everything should be on the screen. It should be like a drag and drop or an Excel, like however the user experience is built, right? It should be flexible, and that's where you should be able to get in and then use it yourself, and it should be understandable. You should be able to fool around and work through a system. A lot of treasury systems which were built in a modular structure 10, 15 years ago, there are modules layered on top of modules, like the hedging is different, this is different, that is different, and it's very complex to learn. Some of them have courses as well. You don't want to go that way. You want to know what you want, basics, and if you have debt, when you have derivatives, you really don't have a choice, to be honest. When you want an in-house bank, you don't have a choice. When you have geographical distribution from China to Africa to Australia to the US, you don't have a choice, really. But when it comes to just the usability of the system, you need to understand that, don't let complexity or complex explaining fool you. You should be able to understand and configure and work through a system. Don't let the consultants tell you that this is, we'll have to do X, Y, and Z, because in the end, today there are systems where a normal Excel user, fairly with some fairly good experience, can manage, right? That's where the usability has to be at the top. That's my thoughts, at least in the current landscape.
Okay. Thank you, Faisal.
I appreciate the opportunity.
Azmat, any questions for Faisal?
No, I think this was great. A lot of good insight on treasury systems, integrations, ERP, EPM, the role of treasury. So a lot of learning, I guess, for ourselves.
Yeah, I agree. That's a completely new world.
Yeah.
Yeah, when I was presenting, when I said to someone, I had to ask someone to put an image in here. There are folks who we work with, and I was like, "Oh, I'm presenting to." Then I thought about it for a second. I said, "Oracle geeks," and I have to explain to them how a TMS works. So was the only way I could find those images and so on that would explain the whole thing. But sorry if there's any offense there, but it was just a funny way of putting it.
No, even in the past, I worked with mining retail organizations and worked with many treasury folks, Bloomberg, Reval, some of the big names. And we always used to get a lot of FCCS, HFM reporting, SmartView out of treasury for them. So now I think everything is coming back again, at least, what these guys are doing in treasury.
Yeah,
exactly. And they have hedging too, because they're larger, then they have our inputs and raw materials. They have sales, which are quality dependent. So yeah, absolutely.
Yeah.
Thank
you so much, Faisal.
Yeah, I'm sure a lot of the consultants who work on EPM would appreciate the learning that
Mhm.
I surely do, because the terminology treasury was, obviously I've seen cash forecasting tools, right? And I know cash forecasting is one of the things that treasury looks at, but it's good to see that entire view and understand what treasury folks do. So thank you, Faisal.
Yeah, you're welcome. Don't let the complex explanations fool anyone. If someone knows what they're talking about, they should be able to explain it to you like a 15-year-old.
Awesome. Okay, I think that's it for this episode. Faisal, appreciate you taking time and connecting with us today and answering all the questions we had. And obviously, we obviously look forward to another session in the future. We can talk more about TMS and maybe some other topics. So thank
Yeah, I
you.
doubt you guys will want to listen about TMS again, but all right. No, it was absolutely loved the opportunity. It was great to
Yeah, thank you,
connect to my
Faisal.
fellow community again.
Yeah,
Thank
Thank
you.
you.
Wishing you
Yep.
success.
yes.
Thank you so much.
Thank
Yeah.
you.
Bye.
Have a good weekend, everybody.
Thank you.
Bye-bye. Thank you.
Bye.